Market-let residential in the UK has been performing very strongly for a number of years. Our most recent figures at the end of 2013 showed a total return of over 14%. Most of that's come from capital growth. Admittedly, our index is quite heavily dominated by London, particularly central London, where extreme pressure on house prices from owner-occupiers and overseas investors tends to push up prices relative to rents. Elsewhere in the country, even within outer London, you'll see the income yield making up a higher proportion of the return. You could hope to get 4 to 4.5% in outer London and the South East, still backed up by pretty strong capital growth as well we saw in the last year and the long run to the end of 2013. In a wider regional context, there is a great deal of disparity throughout the country and performance hasn't been as strong, particularly in the north of the country, as we've seen in London and the South East, although pretty decent returns in the longer term still in areas like the Midlands and the South West. Well, we know that there's very high level of demand for all sorts of housing in the UK. We've got a pretty chronic housing shortage, whether it be rental property or people looking to buy their own properties. So yep, we're expecting to see rents rise further. We've seen rents rising. In terms of having an impact on the rental yield, that will only happen if rental growth exceeds price growth. Now, we have seen prices eclipse rental growth for a number of years, hence the main factor behind this yield compression that we've seen. We've seen income returns drop down as low as about 1.5% net in central London, down to about sort of 3.5–4% net in the rest of London. I think a lot of investors who are keen on the London and South East area believe that the case for rental growth is stronger than the case for house price growth in these kind of areas, areas of good employment, good links to central London for the main employment market in the South East. And they believe that indeed in time rents will exceed house price growth and that they'll see the income yield move out and get more to around maybe the 5–5.5% level net that they would ideally like to be investing into. Well, our market, on taking at face value, looking at the total return, has performed very well in recent years and over a longer term period. We saw pretty significant outperformance of the US by the UK and the main European markets in 2013. I think the US and Germany, for example, were coming in around the 9–10% level. As I mentioned, UK was up above 14%. However, the difference you'll find there is that they are taking a much greater proportion of their return from the income yield. They're enjoying a yield of more around about 4.5% to 5% in the long run. So the investor's actually getting back more each year, whereas investors into UK market-led residential, PRS if you like, have taken a majority of their return from price appreciation. Now, our private rented market from an investment point of view, from a large scale, perhaps institutional investment point of view, is not that well developed. And indeed, the investors who are looking at the market now and investors who want to move into the market, they're really much more interested in that more stable, higher income return. So albeit past performance track record has been extremely good, signs are that it will continue to be good. They would probably like to see a stronger balance of income versus capital than we have in the UK. And yet, indeed, we have seen more of that kind of performance in markets like the US, Germany, other large European markets perhaps, even though they have underperformed the UK market overall.